You can get rich investing in growth stocks. People have done it for decades, but you got to pick the right ones, and you also need to make sure that you're buying them when the prices and values make sense. In this video, we're going to cover 10 future growth stocks that look very attractively priced, and that's very hard to find in today's market. Hello everybody, this is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, a.k.a. Mr. Valuation. Now, those of you who have followed this channel for a long time know that I tend to prefer, at this point in my life, investing in dividend-paying stocks and dividend growth stocks. And I'm looking for companies that can generate a steady stream of reliable income over time, and income that can grow, especially for those of us who are entering retirement or close to entering retirement. Dividend stocks work, but they also have some very safety features and characteristics that make them a little safer to invest in than the growth stocks. But growth stocks have always been a favorite of mine. In fact, in my early years, I started out as a growth stock manager. Now, even today, I like to have a little growth in my portfolio. I focus primarily on good, conservative, dividend-paying stocks where I can let my money work hard for me as I worked all my life for it, and I recommend that to you as well. But yet growth stocks can be fun, they can be scary, they can be risky, but they can also be highly profitable, especially if you buy them and hold them for the long run. As I've often said, you can't really pay too much for a growth stock if it truly delivers on the growth. And here I'm not talking about price changes, I'm talking about growth of the business. Earnings compounders, companies that are small, starting out or on the smaller side, that can continue to build their businesses and grow many times over the years. But the problem with those companies are people recognize them early, and it's very, very difficult to buy them at attractive valuations most of the time. But if you're willing to look carefully, there are opportunities to invest in very fast-growing stocks in the beginning or early in their careers where you can find them at attractive valuations. I found 10 research candidates here. And I want to be clear, these are research candidates, companies that I think are worthy of taking a further look at. But I leave that to you to do your own due diligence and your own work. Some of these I've done that on, some of them I haven't. I'm really in the discovery process here. So let's turn to FastGraphs, as I always do, the fundamentals analyzer software tool to think with, and let's think about the 10 stocks that I found here. But before I actually show you the 10 stocks, I do want to show you how I went ahead and found those stocks utilizing the FastGraph fundamentals analyzer software tool. So let's turn to the tool. Now, the first thing I do when I'm trying to find stocks of any kind, whether they're dividend-paying stocks or they're faster growing stocks, I like to go into the preset screens that we've created. And we're going to be adding to these. We've got a couple screens we're getting ready to add for different objectives and different goals. For example, the dividend challengers, champions, contenders, and aristocrats are on here, and those are stocks that give you the ability to see an increasing dividend income stream that I talked about. But then we also have good growth stocks, and we have growth in returns, another screen, they're slightly different. We also focus on higher quality potential growth stocks, stocks that already met the criteria to be in the Standard & Poor's 500. But then we even hone down on that, and we look at S&P growth stocks that have growth greater than 10%. Because I want to point out, growth is kind of a multifaceted subject. You can have moderately fast growth, very fast growth, unbelievably fast growth, low growth. So growth comes in all types of flavors and all types of configurations. Then we also have small cap growth. So I go through these, and then what I do is I go and I either turn these into portfolios or I go in and create my own portfolios. For example, I have a portfolio here that I call growth, and I'll just search for it real quick. And here's my growth portfolio where I've got 20 stocks in here. Now I can also then look at my portfolios, go back into my portfolios. So what I did is I went through all this process that I talked about, mainly using the screener and then putting them into portfolios. And then I created what I called the cheap growth. Now, the technical name for this in the industry, I'm just naming something here so I can find it, is growth at a reasonable price. Okay, GARP is what that's referred to in the industry. So what these are 10 stocks, and I have a bonus 11th stock here, which is actually Palantir, which is one of the most written about and talked about and blogged about stocks on the planet now because of its strong potential in artificial intelligence. But I'm going to single it out as one that doesn't necessarily fit the criteria that the other 10 do, and I'll show you that here in a moment. But these are the 10 stocks that I've come up with here. Now I'm going to put them in alphabetical order because they're just easier to go through the process with you here. And we're going to look at these stocks. Now I've got cheap growth and quality view. Now another thing I do, because it's one thing to find these research candidates, it's another thing to keep track of them. And FastGraphs also is very powerful in helping you do that. So when I go to my view here that I call cheap growth, what I focused on here is growth of earnings, growth of sales, and then potential annualized rates of return based on the valuations that these stocks have. Now I also look at the dividend yield, the earnings yields, the sales persistence score, and the sales growth score. Now, these are very, very important as well. The higher the number, the more consistent the growth is going to be. So I'm trying to keep track of these companies, and I'll use this portfolio to keep track of them in the future. But then I also created a quality view. Okay, here I'm looking at things like debt to capital. I'm looking at current market cap. I'm looking at credit ratings. And I want you to note here, in this group of 11, there's only 4 of them that actually have, and there's 10 that I'm featuring, but there's 11 in this portfolio. There's 4 of them that are investment grade, 2 that are below investment grade, and some of the more hottest and popular stocks like Block, which is the symbol SQ, used to be called Square, I believe, and then Uber, which is another one. These are lowly rated stocks. And then there's 5 here that don't even have a rating, and that doesn't necessarily mean it's bad. It just means that they've never applied for a rating. All right, so let's go through here and let's look at them now. It's nice to have these views, and it's nice to be able to look at them from a valuation so that I can, in the macro, if you will, I can keep track of the whole portfolio that I've put together here of potential research candidates that are attractively valued today that I might want to invest in. I'm going to put this in alphabetical order, but just before I leave this, I can look at estimated earnings growth here, lowest to highest, highest to lowest. I can look at the highest PE ratios, lowest to highest, highest to lowest. I can organize any of these columns I want to, and this helps me keep track. Now, I'm also looking at estimated annualized rate of return because that's critically what I'm looking for. These are what the annual returns are. Now, I want you to note that Palantir is showing a negative 24% return. That's a calculation, which I'll explain in a minute here in the video. But the point is, these other rates of return are based on what-if scenarios. What if the earnings growth that is forecast happens, and what if they trade at a PE ratio in line with that growth rate? In fact, that's one thing you're going to notice here as I go through these companies. Most of these companies were utilizing Peter Lynch's famed formula for P equals growth rate. When we don't use that, then we're going to be using the Graham-Dodd ... P equals growth rate, or kind of in-between formula. And that's for companies that grow less than 15%. But if I'm looking at Aptiv Plc here, which is automobile parts and equipment, I want you to note that we've had this surge in growth coming out of COVID. This gray represents the COVID era. You can see that the company's growth was interrupted. You can also see they were paying a modest dividend of 20%-ish, 15 to 20% payout ratio. Then they cut their dividend, and finally they eliminated it. But now, if I shorten the time frame, this is a dynamic research tool, and I want to integrate that into this video as well. I use this to analyze things. Just by looking at this picture, I see that I had not so fast growth. I had 45, 15, 16, down to 20% negative growth. And then, of course, the big one where we had -9 and then -60% growth. But now, since then, the company's begun growing again. So I'll shorten this to a 6-year time frame. All right, and what I've got here now is a company that's growing at 29.45%, earnings that is. They're growing their earnings per share, which is 261 to 341, et cetera. And I want you to notice that the stock was trading at very high PE ratios, 65, 70 PE ratios. And then it got into line. Now we're using the P equals growth rate formula here, so we're drawing this orange line equal to the company's growth rate of 29.45. So this is a PE of 29.45 anytime it's touching the orange line. And if it's above the orange line, it's clearly trading at a higher PE. And if it's below the orange line, it's at a lower PE. Now, there's no dividend here. There's only growth. Okay, now the stock did get reasonably valued back in 2022, but that doesn't mean it's going to immediately make you money. It did okay for a while. The price went from $86 to $107 here from June of 2022 to March of 2023, but now it's currently trading at $82 a share. So you could say we've had dead money for 2.5 or 3 years. But in contrast to that, the company's been building value by growing the earnings, and it's forecast to continue growing earnings at a high rate going forward. So the historical growth has been 29.45%. I can see the effects of high valuation would have done nothing but create losses over 3, 4, 5 years here, whatever the time frame is, and quite substantial losses. All right, but now that I can buy this stock at a low valuation, the key is what's it going to be worth in 3 to 5 years. So I'm going to go to the forecasting graph, and I'm going to start out with the estimate tab. Analysts expect this company to continue to grow at an average rate of 22.93, but that's 24% this fiscal year, followed by 28.6% the following fiscal year, followed by 17% after that. Now, I want you to notice there are 24 analysts providing this estimate. The long-term growth rate, it drops down now to only 4 analysts, but is still expected to be about 18%. Now, when I'm looking at this estimate data, this is forecast. This is the future. And these are leading analysts that are theoretically following the company. What I like to do, I'd like to go into external links. I like to go to Yahoo or any other site that I can find. And what I want to do is I want to go into analysis here, because analysis allows me to look at earnings estimates that analysts that are reporting to Yahoo, and that's a different set of analysts. These guys get them from Reuters, we get them from FactSet. Now they're saying next 5 years 26%, next year 29% of growth. Okay, so if I look here, next year, if I go back to the estimate tab on this, we're looking at 24% for next year, about 4% less. Our long-term growth rate is only 17%, where the other site, Yahoo, gives me 28% in terms of long-term growth for the next 5 years. All right, so the point is these are analyst estimates. And by the way, analysts have gotten it wrong quite often on these companies, and that's something you'll find with these high-growth stocks. But the point is you can create these what-if scenarios. So I like to stick to the estimates tab, and I like to usually stick to this year and next year and maybe go out 2 years depending on what kind of confidence I have. Now again, analysts have missed 40% of the time or more, they've missed the growth estimates. Okay, and they've come in lower, but they've come in moderately lower, not just massively lower in many cases. And keep in mind, that was going through the COVID period, as I showed you in the beginning. So now, assuming the stock grows at 22% and it trades at a PE ratio equal to its growth rate of 22, this would calculate to a 43%, just under a 43% annualized rate of return out to 2026. Now, again, and the secret, as you can even see by this graph, is you got to hold these stocks for the long run. That's where the 10 baggers and the 100 baggers even that have been talked about on Wall Street have come from. They've come from buying very fast-growing businesses and holding them for the long run. They aren't necessarily instant success. And by the way, when we're looking at this stock, let's analyze this stock from a historical point of view. We can see that it got really overvalued coming out of COVID. And again, this company makes auto parts and equipment. We'll talk about that. But from this overvaluation, this was a very dangerous time to buy the stock. You'd have lost over half your money if you'd have held it from November going forward. So the high valuation was a problem. Now it's becoming reasonably valued. Now, based on this graph, but again, what's important is to shorten the time frame here to look at what the growth has been more recently. And we would say, looking at the stock, if you can buy it at a 15 PE with over 20% growth expected in the future, it would be a very, very attractive growth stock now. Now, the question is, what does the company do? I'd like to go into the company's website right out of the Fast Graph tool, okay? And what I do is I look for insights into the company, as they have one here called Insights. And they talk about smart vehicle architecture, software, sustainability, user experience, and their solutions. They have advanced safety, connected services, middleware, and develop ops, smart vehicle architecture. So this is vehicles of the future with electric vehicles and smart vehicles. So they don't make carburetors and springs and things like that like a lot of auto parts maker. They're really into sophisticated auto parts, and maybe they're on the forefront of the future or not. That's up to you to decide. But the point is the stock looks very attractive. Now, just for sake of brevity, let's go ahead and go through these a little quicker now. Let's go next to Coastal Financial. Now, this is a financial, and I want you to notice something about this. The company's historical growth rate has been very fast. And again, I'm going to go into because I don't know this company, I'm going to go into the external links, and I'm going to look at Coastal. And what you'll find out about Coastal is that they are in the West Coast, okay, and they're a small company, and they've been growing. If I go up here and look at locations, okay, I can then see where they're located and go into the map here, and I can blow up the map and I can see where they're located in the state of Washington here on the West Coast. So they're called Coastal Financial. Okay, and this gives me all their locations and the different locations they have throughout the country. And they're out of Everett, Washington. So again, I can learn some things. I'd spend a lot of time here learning about this company, but it's a fast-growing community bank, regional bank it's being called. Doesn't pay a dividend. It has a small cap, 611 million, but it's large enough, no credit rating, and we're not showing any debt to capital on the stock. From a forecasting point of view, it's expected to grow about 8% this year, followed by over 50% next year, and then the long-term growth is not given on this stock. So that would be something that you would want to be cautious of when you're doing your research and due diligence. But this might be one that's a little less aggressive than a company like the first one, Aptiv, which I showed, and some of the others I'm going to be showing, because it's more of a bank, but it's a small bank that's growing very fast. So it might be one to look at, but it's not necessarily the quintessential growth stock. Again, you can buy it at a blended PE of 13, a very high earnings yield, but note that normally the stock has traded at a discount. If I go into the forecasting calculator here, forecast growth is for 35% over the next couple of years, but mainly because they're banking on big growth in 2025. I want you to note that. The normal multiple has only been about 16 times earnings, but this would still give you a very high rate of return if the company traded at a 16 PE. If it only traded at a 14-ish PE, 14.5 PE, you'd still be looking at making 43 or 44%. So this could be a really great opportunity, but again, you got to do your homework here and figure out if it really suits your investment if you're looking for growth stocks. The next one I want to look at is Expedia. Now, Expedia is a very interesting growth stock case too, because this was a pretty fast-growing company. Again, if I use the scroll bar feature fast graph and go back to pre-COVID, it was growing at double-digit rates, 12 or 13%. It had some good years and some bad years. You can see that in here. But then it did creating some double-digit growth. It grew at 24, 23, 72, 13, had a 4% growth rate. And of course, notice how the stock price came down at that point, but then it was growing at a high rate again. So it was doing pretty well, and the stock got pretty overvalued. And once again, just by looking at fast graph, it gives you a perspective. I don't know of any other tool. I can just see here that once the stock got really highly valued, I didn't pick the peak. You could go for a long period of time where you just didn't make any money owning the stock, even though the business was doing okay. A little bit up and down, really strong growth followed by weak growth, etc. But the stock got pretty overvalued, and it was a poor investment, but yet the business was doing well, and they were actually growing their dividend over that time. But now if I go forward, take this forward, we see COVID came, and of course COVID hit them. This is the travel, hotel, resorts, and cruise lines company. It looks like Carnival Cruise Lines and Royal Cruise Lines would look very, very similar to this. But the company, so to speak, getting their mojo back. They aren't paying a dividend right now. But let's just run this again as a 5-year graph, and let's look what they've achieved historically over the last 5 years. Now, when you get a real high growth number like this, you got to be smart enough to realize that that came from the company kind of moving back, if you will, into a historical normal earnings range. Like they were earning $6 and $5 here. They're now moving back to earning, expected back into 679, which would be above their previous best year, which was 2019. So they've kind of gone through the COVID, the loss of the cruise lines, and blah, blah, blah. People not traveling, people are beginning to travel again. So they've started to accelerate their business. But let's even eliminate this 61% growth is sort of being biased by this 300% growth. So let's cut another year out. And this company's been growing at 28%, 43, 22, 24, 24. So it looks like 22, 24, 24 is becoming what expectations are going forward. So if I go into forecasting, I simply learned that 23% is the number that analysts expect. The normal multiple on this stock over the last several years has been about 17 times earnings. You can use the fast graph drop down here and look at normal valuations for the stock and see that a 20 or 19 PE has been pretty normal. 17 could be conservative. Even at that number, we're looking at a potential to make 49% a year annualized because the stock is currently inexpensive. If we look at the estimate tab using the P equals growth rate of a 23 multiple, we could be looking at 65% or 60% plus annualized rate of return going forward, where you would $10,000 into just under $40,000 over the next 3.5 years or so. Growth stocks can be very exciting, but they're also risky because I want to point out achieving 20% growth is hard to do. Now, moving on, let's go back through. We're going to look at one of the more conservative ones here. We're going to look at FedEx here. So first of all, let's look at it from a historical. It's been a double-digit grower. And again, I can pick spots in here and get different growth rates, but 9 or 10% has been a very consistent growth rate for this company going back to 2012. During COVID, they did get hit. They had some issues going on here, I believe, with Amazon, but then they put together a couple of really strong years, and then earnings fell again. Now earnings expectations going forward are for the company to continue to grow above my 15% threshold. So I'm using a P equals growth rate formula here. This orange line is a PE of 17.75. In this case, I do get a 2% dividend with a pretty good dividend record, and so I can just immediately point here, and I can be making over 30% a year over the next 2 years if the company achieves this growth and it does trade at that multiple. If I go looking at the normal multiple, which is lower than the growth rate, about 15, I still stand to make 17 to 20% or 25% a year with a nice dividend on a triple B rated company, which is much safer from a standpoint of the other stocks that we've looked at so far today. This would be one of the few investment grades companies on my list here. The next one is Shift for Payments. Now, one thing I want you to notice when I go into the portfolio here and I look at the sectors and the sub-industries, there's several transaction payments, 3 transaction payment companies that have got my attention here based on the fact that these companies are participating in the online business and all the payments that are going on with all the technology that's being done over the internet right now. And so transactions for things like restaurants and so on becomes very important. And again, I can go into Shift for Payments. I can go directly into their corporate website. And this company is primarily dealing with end-to-end commerce solutions with things like Skylab Mobile. I'm not sure what that is, but again, you can look at all this. Here's their partnerships that you can look at integrated. You can go in here and learn about us, go into the investor services, and look at what Shift4 does.
Shift4 is an industry leader in
what they do. Again, I want you to do your own due diligence and research here, but let's looking at it from a data point of view. The company's historical growth rate historically has been over 50% a year. But again, there's some really aberrant numbers here when the company was just starting out. It's now a $4.3 billion company. It does have a lot of debt, no credit rating. Okay, looking at forecasting going forward, analysts are expecting over 20% growth. Again, this could lead to some very, very attractive returns. They have beat estimates every year, which is very, very good. So this is one that might be attractive from that point of view. From a long-term growth, analysts expect 40% growth, but there's only one analyst giving that growth rate here. Again, I can go into the external links. I'm not going to waste the time to do it. Go into Yahoo, go into analysis at Yahoo, and then quickly look at what the growth expectations are going forward for this company. Growth estimates for the next 5 years are 49% by Reuters, so you get some corroboration here. Both companies think this is going to be over 40% growth. And again, long term, this could be it could be a 10-bagger over the next 5 years. Looking at it more conservatively for the next couple of years, it could turn $10,000 into 16 or 17,000 just over the next 2 years, and that would give you an annualized rate of return of 21%. And again, there's a lot of other places you can go to Fast Graphs and learn about the companies. And you can go into the financial statements. You can go into our fund graphs, which you get some really good data on there. But again, I'm trying to keep this as simple as I can. First Solar is a very interesting one to look at. If I look at it historically, we know that solar has been a burgeoning energy opportunity. The company started out with some pretty good growth numbers and some pretty high expectations, but then they went into a long period of negative growth, we'll call it. From here, if we had $7 of earnings going down to $4.38 through 2021, and then of course you had a negative, actually a loss in 2022, but now all of a sudden the company's growing again. If I look at the forecasting calculator, analysts are expecting 53% growth. There are a lot of analysts in this universe, I want to point out. The scorecard is credible. The analysts have missed it 25% of the time. And again, the big misses were during the rough years coming out of COVID, as you can see. All right, so this company has a decent forecast going forward. Long-term growth is expected to be over 50%. Again, I could go into Yahoo and check that. But I could also, once again, go into the company's corporate website and I could learn about this. And this company makes these solar fabric, I guess you'd call it, that are state-of-the-art. And so they're probably the leader and the world's largest. So First Solar looks very, very attractive. Current valuation is trading at a 20 multiple, which is way lower than their growth rate. And we're capping this with a 30 multiple here and still get a chance to make over 60% a year. Right? If you were looking at faster growth, and you could put faster growth in by going to our custom calculator, and you could enter the 50% plus growth rate. I'll just do 50 to keep it simple here and draw the growth there. And at 50% growth, going out to a 45 PE, let's say it's 65, 70% annualized rates of return on First Solar. So it's very, very interesting. Now going on, Global Payments, this is another investment grade company with low date, another transaction processor. I've covered this one before. Forecasting, this would be a safer bet, double-digit growth. We're giving you decent rates of return, but the real attraction here is the fact that the stock has gotten so cheap after it was overvalued, and nothing's really changing in the growth rate. It's still going to continue, expected to continue growing at a pretty fast rate. Now, Palantir is the hot stock on the market. Now, I want to show you something. I'm going to go back into the portfolios here and show you how I use this to evaluate stocks. I'm going to look at estimated earnings growth. Okay, now I'm going to look at Palantir at estimated growth of 21%, and then Shift 4 at 21%, and Aptiv at 23%. The difference here is, though, I've got a 15 PE on Aptiv, I've got a 20 PE or ish on Shift for Payments, but I've got a 75 PE. Now, sales growth for Palantir is expected to be very strong, and I'm going to show you that, but my point is, if I'm looking at earnings growth of 20% on these four companies, really, even Expedia is expected to grow at 23%, why am I willing to pay 75 times earnings to buy it when I could buy this other growth? Now, it could be because of the opportunity, the belief that it's going to grow faster, etc. But if I go into Palantir, which we did here, and look at it from an operating earnings point of view, it doesn't look so hot. If I look at forecasting graph, analysts are expecting over 20% growth. There are 15 analysts that are making that forecast out to here, and then it drops down to 5. So if we just stay out to here, if this traded at a 21 multiple, in other words, if we had PE shrinkage here, even with all this growth, you would lose over half your money by buying the stock at these current valuations. Price is what you pay, value is what you get. Long-term growth is expected to actually be higher, but before you really start getting into positive rates of return here, you'd have to hold this stock for 4 or 5 years. And that's something very difficult for people to do. But I've also got all these other metrics I can look at the company with. And a stock like Palantir is trading, as you'll see, at a pretty high correlation to its sales growth. Its sales growth has been about 22%, and it's currently trading at 20 times sales. And the normal price to sales has been 21, so it's kind of trading in line. Looking at forecast to sales, sales are expected to grow at 20%. So if you're willing to take that risk and hold this stock long enough, it could still be a winner today. But I do want to make a point. It was obviously a better buy when it was cheap here, even though you wouldn't have made any money holding the stock over this little more than a year's holding period of time. You'd have lost almost 40-some% of your money, 33% of your money, or been down 28% annualized. Price is what you pay, value is what you get. But if you would have bought it during these low times and held it to today, you'd be making over 25%. So we can see the impact of valuation. The peak valuation back here, if you'd have bought it, you'd still be underwater after all these years, even though this is a hot stock. But if you'd have bought this stock when it got more reasonably priced at the 6 or 7 times sales and held it for the next year and a half, you could have tripled your money and made over 136%. That's why I'm such a value-oriented investor, because again, price is what you pay, value is what you get. Moving on here, let's go to Block. This is a very interesting essay on valuation. I want you to note the stock was very hot. It was one of the hottest stocks on the market. But look when the valuation got really peak here. You could have gone a year or so and not made any money or lost money. And again, you could run this at all these different picks here. But even if you'd have bought the stock back here when it was not as overvalued and held it till today, you'd lost roughly half your money and be down over 17% annualized. And yet the company has been growing very fast during that period of time. Now we've got it at an attractive valuation. The forecast is for the company to grow at 36% going forward. The long-term growth rate for the company is expected to be 39%. And again, you can check other estimates. You can also go into the company's website here and look at all the things they do, the way that they work with retail and different products and services that they have, and learn more about the company. But the point is, it is expected to be a powerful growth stock going forward. And now for the first time, perhaps in its short career, you can buy the stock at a price that at least makes some sense, okay, and a value, more importantly, that makes some sense. All right, these high valuations led to some pretty scary, even back here, if you'd have bought it back here when it was highly valued, and watched the stock go from a price of 99 up here to double to 190 or 180, but then now today you're looking at it being a $70 stock. And again, you'd have been losing money or had dead money all these years because you found a good company here, but you paid too high a price for it. Okay, moving on, let's go to Uber. I find Uber to be another interesting one. What kind of an investment has Uber been? It's been a hotly talked about stock, but there are years and years you could have owned this stock and lost money. Okay, it's now just now starting to make money. And frankly, the price now is trading at a value that's pretty high, even though growth going forward, earnings growth going forward is expected to be very strong. Again, this would be one of those companies you might want to go here and use the other metrics like price to sales and get a little different picture and perspective of how the company's sales growth has been very strong. And that's how the market has been valuing the stock. But once again, you want to pay a reasonable multiple of sales to buy a stock like this, because if you pay a high value for it, even though ultimately the stock goes up, you make about 4 or 5% a year. If you buy it at a more reasonable value, even not the best value, you can instead be making over 30% a year on your money. And it's just valuation is so important, especially when you're looking at these high growth stocks. Okay, here's Clear Secure. Here's another one that's literally been dead money its entire career. We'd have lost money holding the stock. The stock is now trading at 20 times earnings, expected to grow at 28% a year, and it has a long-term growth expectation of 25% a year. So now you can begin to buy this stock again. You can go into the external links. I'd like to spend time in these corporate websites and try to figure out what the company does, who they are, what their business is. This is how you can do your due diligence to decide, does this company really have a future that you feel they can grow their business, and that you can then, by buying the stock at a reasonable valuation, grow with them. All right, so that's the end of the stocks. Now, 10 on here I think look attractive. Palantir, Going back into this, Palantir looks like it's very expensive now, but again, if they grow like their analysts expect it to, you could end up making a great deal of money investing in this stock if you held it long enough and even were willing to commit more money as time went on. Anyway, it's been Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool. I hope you enjoyed this long dissertation on growth stocks and how growth stocks can be very profitable for you over the long run. And you can even overpay for them if you're willing to hold them long enough. But that's a very important statement. How many of you are willing to hold a stock through thick and thin if it's going down in value? And from my experience, not very many of you. But if you focus on fundamentals first rather than stock price movement, you can pick times to find these stocks. And FastGraphs can help you find these companies like this or other companies like it, and helps you also keep track of them so that you can pick the times when you should be an investor in them. Hope you enjoyed this video. If you did, give me a like, share it with others, subscribe to the channel if you haven't already, and then also take a look at the FastGraph Fundamentals Analyzer software tool. It makes stocks investing fast and fun again. And like I like to say, it's the value investor's best friend. Thanks for watching.